Hey, how's it going? Joe Camberato here, entrepreneur, CEO, and founder of National Business Capital. In this video, I'm going to talk about business lines of credit, what the actual interest rates are, and a few things that you really should know and is very important for you to understand. So I founded National back in 2007. Since then, we've been able to secure over $2 billion in funding and have completed over 27,000 transactions. That number continues to grow every single day. When I started National Business Capital in 2007, I really had one mission, and that was to create a platform that business owners can apply and access all the different lending products that are out there for their businesses. So we've done exactly that. There's over 75 lenders on our platform. We do everything from SBA loans to term loans to business lines of credit. You can apply in one place. You can speak to a knowledgeable team that's experts in business lending. They can explain all the different options that are available, all the different interest rates, and help you make a decision on what's best for your business. And even better, they work with you all the way from application all the way through funding. We can also bring back multiple options to you so you can pick the best one for you and your business. And sometimes what we find is you may think that you need a business line of credit, but there may be another product that's available that you don't even know about that makes more sense for your opportunity or challenge in your business. What's really important to understand is there's two types of lenders today. There's a bank, and then there's non-bank lenders. Non-bank lenders can be called fintech lenders, alternative lenders, but they're really any type of lender that's outside of a bank. Banks typically will give you your best cost of capital or your cheapest interest rate. But getting approved for a bank is complicated and much more strict. The guidelines are harder. Banks will typically look at personal credit. They're usually going to want a very strong personal credit score, 700 plus, sometimes less, but usually much higher. They're going to look at the collateral that you have in your business. Collateral can be real estate, it can be inventory, it can be B2B receivables, it can be big equipment and machinery, and then they're going to want to see that you're profitable. So if you're not profitable, typically that will knock at a bank. If you don't have collateral coverage, that usually will also knock at a bank. And if you don't have a strong personal credit score, that also will knock out a bank. Now, if you have all those things, that's great. You may be able to look at some bank financing or pull in a very business-focused bank where we can leverage those receivables and give you a really competitive interest rate. You do have to remember when working with a bank, the process is usually longer. It's about 30, 45, 60, 90 days. So typically when going to a bank, you're going to get approved for a prime rate plus a certain percentage. That total number, when you add it together, is your effective rate. What's important to understand is with banks, they're going to look at all of these different factors: personal credit, business credit, financials, profitability, collateral coverage, and then those different factors will make up your interest rate. What rate you may get may be different from what another business owner will get based on their business versus your business. That's completely normal. That happens every single day. So when getting a business line of credit from a bank, the most important things are going to be that you have B2B receivables or real estate that they can utilize for their collateral coverage in order for you to get a large line of credit. Now, most banks will give you up to $100,000, maybe $250,000 if you've got great credit and great profitability. But once you start going beyond those amounts and you want a higher amount or your business grows, if you don't have B2B receivables, like if you're selling like Walmart, Target, big companies, you can use those receivables as collateral to grow your line of credit. But if you don't have those things, you're direct to consumer, you're in construction, it's very challenging to usually grow that line of credit unless you're doing all commercial or B2B type of work. So if you don't have those things, then you're going to absolutely want to look at a non-bank lender. There are a number of different lenders out there that will look beyond you just having real estate or B2B receivables. They will look at your credit, but they're more lenient. They'll go down to typically a 600 credit score or higher. And they're going to be very focused on cash flow instead of B2B receivables or real estate. Because they're more lenient, because they move faster, a lot of non-bank lenders, you can get approved for a credit line today in 24 hours to 3 to 5 to 7 business days. So it's a lot faster underwrite, it moves a lot faster, and they're a lot easier to get. So because of that, the interest rates are higher. Typically in the non-bank lending world for a business line of credit, the rates will be somewhere around 1% a month, which is about 12% annually, and will go up from there based on risk. So you can be somewhere in that 12 to 18% range. But the good thing about a line of credit is you only pay for the interest for as long as it's outstanding. So if you borrow money for 30 days and pay it down, you can have a rate as low as only 1%, which is really great. Whether you're working with a bank or a non-bank lender, a lot of times owners will focus on the interest rate. And of course, getting the best rate that you can, you want to do that for your business, and you should. But if you've got an opportunity in your business, you really need to understand the ROI and how to use financing or a line of credit and that type of leverage to scale and grow your business, and to use other people's money to get a return in your business. So it's really simple. If you understand what the opportunity is and how much you can make by using a line of credit or other people's money in your business, and the opportunity and the amount of money you can make outweighs the cost of capital, then obviously it would make sense to use a credit line to grow and scale your business. All right, I hope you found this video helpful. Please remember that interest rates are changing every day for business lines of credit. Guidelines are changing every single day. So when you're ready to move forward, reach out to my team so you can find out what the rates are at that time. But more importantly, so you can share whatever the opportunity or challenge is in your business that you need a line of credit for. They can talk through it with you. They can let you know exactly what your options are, how much you'll get approved for, what the terms will look like, what the rates will look like. And also, they may suggest other products and programs that are available that you may not be aware about. So it's really important to work with a true business financing advisor that understands all the different lending options so you can make the best decision for your business. Thanks for watching this video. I hope you found it helpful. I want to wish you nothing but success in your business, and make sure you keep growing.